Thousands of people are sitting on a ticking clock right now and they don't even know it. Not because they did anything wrong, not because they moved money illegally, not because they were hiding something, but because of a single account. An account sitting in another country. An account they've had for years. An account they haven't touched in months. An account that, in their mind, has absolutely nothing to do with the United States. And right now, that account could be the one thing standing between them and a United States passport. I've seen the comments, I've read the messages. The most common thing people say is this: I didn't bring any money into the US. I didn't transfer anything. I don't earn interest on that account. So why would I need to report it to the IRS? That question is exactly why we're here today. Because the answer is the most misunderstood rule in all of US tax law. And in 2026, the penalty for getting it wrong just got bigger. Stay with me through this entire video, because what I'm about to explain affects green card holders, permanent residents, naturalization applicants, and even some visa holders. And the consequences are not just financial. They go straight to the heart of your immigration future. While social media is full of noise on this topic, some people saying, don't worry about it, others saying, you'll get deported tomorrow, we are looking at the official text, the actual IRS guidance, the actual FinCEN regulations, the actual USCIS naturalization standards. Remember, I am an analyst guiding you through the system. This is educational content, not legal advice. Your situation is unique, and you should always consult a qualified immigration attorney or tax professional for your specific case. But what I can do is make sure you understand the rules clearly, because confusion is what gets people into trouble, and clarity is what protects you. So let's start at the beginning. The rule is called FBAR. It stands for the Foreign Bank Account Report, and it is filed not with the IRS on your tax return, but separately through a form called FinCEN Form 114, submitted to the Financial Crimes Enforcement Network. Now, the name sounds intimidating. Financial crimes. That sounds serious, and the truth is, the government does treat this seriously. But the vast majority of people who fall into trouble with FBAR are not criminals. They are ordinary people who simply didn't know this rule existed. Here is the rule in plain language. If you are a U.S. person, meaning a citizen, a green card holder, or someone who meets the IRS definition of a tax resident, and if at any point during the calendar year 2025 the combined total value of all your foreign financial accounts exceeded $10,000, you are required to report those accounts. Not the income, not the transfers, the accounts themselves. Even if you earned $0 in interest, even if the money never moved, even if the account has been sitting there since before you came to the United States, if the balance crossed $10,000 for even a single day in 2025, the reporting requirement was triggered. Let that settle for a moment. One day, one moment where your account balance, combined across all foreign accounts, went above $10,000. That's the threshold, and most people don't realize it applies to the aggregate, meaning the combined total of all your accounts added together, not each account individually. So if you have 3 accounts abroad, one with $4,000, one with $3,000, one with $4,000, that's $11,000 combined. You are required to file. Now let's talk about what happens if you don't. This is where I need you to pay close attention, because the 2026 penalty numbers are inflation adjusted and they are significant. For a non-willful violation, meaning you simply forgot, you didn't know, it was an honest mistake, the penalty can be up to $16,536 per year of non-compliance. Per year. So if you've had a foreign account above the threshold for 3 years and never reported it, you're looking at a potential penalty of close to $50,000 for forgetting. Now for willful violations, meaning the IRS determines you knew about the requirement and chose not to comply, the penalty becomes the greater of $165,353, or 50% of the account balance at the time of the violation. 50%. If you had $200,000 in a foreign account and the IRS determines your failure to report was willful, you could lose $100,000 in penalties alone. These are not hypothetical numbers. These are the 2026 inflation-adjusted figures straight from official guidance. And here's the part that makes people uncomfortable when they hear it for the first time. The IRS already knows. Under a law called FATCA, the Foreign Account Tax Compliance Act, foreign banks around the world are required to report account information for U.S. persons directly to the IRS. Banks in the UK, banks in India, banks in Mexico, banks in Canada, banks across Europe, Asia, and Latin America. They are sending your account data to the U.S. government, whether you file or not. The IRS is not waiting for you to volunteer information. They are receiving it automatically, which means that if there is a discrepancy between what foreign banks reported and what you filed, that discrepancy exists in their system. Most people who come into compliance do so voluntarily and avoid the worst penalties. The people who get hit the hardest are the ones who wait, get identified, and are then seen as having had the opportunity to come forward and chose not to. But this is where it gets more serious than just money. Let's talk about what an FBAR violation does to your immigration status, because this is the part that most tax advisors don't explain clearly, and it is the part that matters most to this community. If you are in the process of applying for U.S. citizenship through Form N-400, one of the central requirements is demonstrating what USCIS calls good moral character. This is not just a vague character assessment. USCIS goes through your tax history. They verify that you have filed all required returns. They look at whether you have met your obligations to the U.S. government during your period of permanent residence. Failing to file an FBAR is technically a federal reporting violation. In more serious cases, it can be characterized as tax fraud or tax evasion, and tax fraud is one of the specific grounds that USCIS uses to deny a naturalization application based on a failure to establish good moral character. This means that an account you opened years ago, an account you didn't think twice about, an account where you genuinely didn't know there was a reporting requirement, can surface during your N-400 interview and create a serious problem. Now here is an important nuance that most people get wrong. If you are simply renewing your green card using Form I-90, that process does not typically dig into your detailed tax history in the same way. A routine green card renewal is generally administrative. But the moment you apply for citizenship, you have opened the door to a much deeper review. USCIS officers are trained to ask about foreign accounts, tax compliance, and financial obligations. And if something comes up during that review that suggests you had unreported accounts, you will be asked to explain it. The difference between a green card renewal and a naturalization application is the difference between a routine checkup and a full audit. Let me make this real for a moment. Think about Priya. She came to the United States on an H-1B visa 8 years ago. She became a permanent resident 4 years ago. She has been a model resident. She works hard, pays her taxes, and has been looking forward to her naturalization interview. But back in India, she has a savings account and a mutual fund that her parents helped her open in her 20s. The combined value has fluctuated above $10,000 multiple times over the years. She never thought about it. It's money she was saving for a future trip home. She never brought it to the U.S. She never earned significant interest. But she never filed an FBAR for 4 years. Now she is sitting in a naturalization interview. The officer asks about foreign financial accounts. And suddenly, something she never considered a problem has become the most important issue in the room. This is not a scare story. This is the conversation that immigration attorneys are having with clients every single week. So let's look at the facts, not the fear, and talk about what you can actually do right now. The first step is to determine whether you have a filing obligation. Go back through 2025 and ask yourself whether, at any point during the year, your foreign financial accounts combined exceeded $10,000. And remember, this includes more than just bank accounts. It includes savings accounts, checking accounts, investment accounts, mutual funds, and even certain life insurance policies that carry a cash surrender value. If you have a whole life insurance policy abroad with a cash value above the threshold, that policy may need to be reported. If you had accounts that crossed the threshold, your next step is to file FinCEN Form 114 through the BSA e-filing system at bsaefiling.fincen.tris.gov. This is a free filing. It is separate from your regular tax return. The deadline for the 2025 reporting year is April 15, 2026, and there is an automatic extension available to October 15, 2026. The third step, and this is critical if you missed previous years, is to look into the streamlined filing compliance procedures. This is essentially an IRS amnesty program for people who failed to file FBAR in previous years due to non-willful conduct, meaning they genuinely didn't know or forgot. Under the streamlined procedures, you can come into compliance, pay a reduced penalty, and have your case resolved without the full weight of the standard penalty structure coming down on you. There are two versions. One for people living in the United States and one for people living abroad. A tax professional who specializes in international tax compliance can walk you through which applies to your situation. The worst thing you can do right now is nothing, because the banks are already reporting. The data is already being shared. Coming forward on your own terms is always better than being identified. Immigration policy, tax enforcement, and the rules that govern your status in this country are not static. They shift, they tighten, they expand, and the people who stay safe are the people who stay informed. If today's video made you realize something you need to address, please act on it. Talk to a tax professional. Talk to your immigration attorney. Come into compliance before your naturalization interview, not during it. And if this video helped you, share it with someone in your community who needs to hear it, not to scare them, but because knowledge is the only real protection. Subscribe to this channel so that when the next policy update hits, when the next deadline approaches, when the next rule changes, you hear it here first, clearly and with context. Your status is too important to leave to rumor and panic. Stay informed, stay protected, and we will see you in the next one.